I'm your host, Neeraj Shan. Our guest today is Rob Subbaraman. He's the head of global market research at Nomura. Rob, great having you. Thanks for joining in. Hope all is well.
Great to be here, Neeraj.
Thank you. Thank you. The pleasure is ours. Rob, how do you look at the year gone by and what it could portend for the world markets at large and the EMs in particular for 2023?
The world gone by in 2022, I would say I look back with a huge amount of humility in terms of how much we got wrong as economists. We never expected inflation to go up so much. We never thought central banks would raise rates so much. To be fair, some of the things like the Russia-Ukraine war were pretty hard to forecast. But I think, economists generally, the pandemic shock did not read that thoroughly either. So I go into 2023 with a lot of humility, and I realize that there's huge amounts of uncertainty there, probably the most I've experienced in my career in looking into the next year and just how much uncertainty there is.
Wow, and yet we'll make you predict, Rob. Don't worry about it. We can talk back same time next year about whether you got it right or wrong. Yeah, and asking questions is mine. So, okay, let's try and distill this into two halves. The one, I want to first talk about the world markets. The consensus view, Rob, is that the West enters into a bit of a recessionary phase. Maybe the US escapes it or has a mild one, but the Eurozone certainly has a big one. But we know since 2020, arguably in India, even before that, that economy and markets need not have a direct correlation or 1:1 correlation. So how do you think the Western economies or the developed world performs economically in 2023? And can the markets have a different texture to that performance?
Okay, so Neeraj, so for the economy first, the Nomura view is that the big economies, so US, Europe, are going to be going into recession. In fact, we think they're going into recession right now. And it will be quite long-lasting recessions, lasting through the whole of next year with negative growth quarter on quarter. And that's, I think everyone understands the reasons: cost of living crisis, but also very aggressive monetary policy tightening. And they're long-lasting recessions because we don't think central banks are going to quickly come to the rescue. Inflation is still too high for them to really contemplate cutting rates anytime soon. I would also point out that the world's second biggest economy, China, is going to go through what we call a bumpy recovery. So China is in the process and very quickly moving away now from its zero COVID strategy. We do see growing signs of a massive wave of infections. And we think that is going to lead to some disruptions in the short term. Ultimately, it'll be good, but near term, it will be bad for the economy. Markets, as you rightly pointed out, they are forward-looking, and markets are kind of, I would say right now, looking very, very forward, maybe too forward, in when central banks could cut rates and when China will get over this hump. I think the risk is in the first quarter of next year, January through March, there could be some risk aversion coming back into play and some move away from risk assets as growth slows more sharply, unemployment goes up, and central banks are not ready to cut rates yet because inflation is still too high from their perspective relative to their targets.
Okay. So would you reckon that there could be, are you baking in a mean reversion for risk assets? Because currently they are looking too far, and at some point of time, a reality check sets in about what is there in the short to the medium term?
In short, yes, that's correct. We think there could be some repricing because markets, we think at this stage, in a way, looking too far ahead, and the reality on the ground is going to show that growth profits are going to be under a lot of pressure, and central banks, unlike in typical times in recent decades, are not going to quickly come to the rescue.
Okay. Okay. No central banking put in place. Rob, what does there was a note that I was reading which believed that investors the world over are over-invested in developed markets and under-invested emerging markets. Now, one, would you believe that to be true? And two, if that is indeed the case, could we see money piling into EMs in 2023? Because the Western world might have a recessionary stroke equity markets corrective phase as well, and EMs might relatively be faring much better.
So what you say about the global investors underinvested in EM, I think that is correct. If you look at positioning and portfolio flows, it does seem to be the case. Our view is that when the global economy starts turning and starts recovering, we do think EM is going to be leading the recovery, not DM. So we would concur with that. And in particular, we think Asia EM will be leading the recovery. But as I mentioned earlier, I think some patience is needed, because I think we are going to have another market wobble early next year. But particularly for the second half of next year, in terms of economies, I think we will start to see Asian economies leading the recovery. But in the first quarter, I think Asian exports in particular are going to be hit very hard.
Yeah, and therefore maybe differentiate between the exporting economies versus otherwise. Just wondering though, Rob, this wobble that you're talking about, is it going to be slightly more than a wobble? And two, is there a catalyst leading to the wobble in terms of either commentary or jobs data or recession or the growth data coming out, or would it be seasonal in nature, in that it would happen without people quite realizing it, the reasons thereof?
I think if I'm thinking for catalyst, Niraj, I think it will be more on the growth side. So things like non-farm payrolls starting to turn negative in the US, ISM, PMI surveys falling more sharply. And then combined with that, central banks upsetting markets by not giving any hints that they're ready to cut rates yet. So I think that's going to be quite a bitter pill to swallow for markets. We'll see. It's very hard to gauge, how much markets could sell off from that. But I just did want to get back to when we were talking about EM, and you made the very good point that less export-orientated economies could do better. We do have the view at Nomura that when EM starts to recover, and particularly Asia leads the global recovery, the new shining stars are actually going to be India and ASEAN in Asia, not China, Korea, Taiwan. We think at this time it will be more what used to be known as the Asian cubs. We think they're turning into these tiger cubs, will be graduating into full roaring tigers in the coming years. And there's many reasons for that, which I can talk about. But that's where we think ASEAN and India, we're going to have among the highest growth rates in the world.
Would love to know the reasons, Rob.
Well, there's many, but I would say, so if we look at fundamentals, economic fundamentals, in terms of not just growth rates, but also in terms of balance sheets, how healthy they are, we would say ASEAN, India are in relatively good shape compared to other EM regions. We also have in ASEAN, India, very good demographics relative to other EMs. We have also this digitalization of the economies that is rapidly gaining momentum. We have China plus one. the diversification of multinational companies, which we think it will continue to happen over time. But if we look at it over a 2-3 year horizon, I think it's going to be quite beneficial for India and ASEAN. So there's a number of reasons. And the other thing that we think will start to play out, and this is typically how it happens as these developing economies start to catch some growth wind, is you get strong capital inflows as foreigners want to be part of this, and that adds more domestic liquidity, and that leads to higher growth, and that attracts even more capital inflows. So it's a little bit of a virtuous spiral. If policymakers play their cards right and keep policies fairly prudent and push ahead with productivity enhancing reforms and infrastructure and so forth, we do think India, ASEAN really have everything to play for if we're thinking about the next 2-3 years.
Rob, the interesting thing is the sound bites around India are very positive. I mean, I keep on reading on every third day on Bloomberg, a new global multinational opening yet another plant or thinking of opening yet another manufacturing base. And it's happening across spheres, large, mid, small. So in terms of the manufacturing shift to India is not unheard of. Indian services looking okay. Indian corporate balance sheets looking okay. Banks primed to lend. Everything sounds okay. My question, therefore, is, but because India is an expensive market, my question, therefore, is, do you reckon that foreign flows will still come to India at these expensive valuations because the belief might be that India will stay expensive? Or will foreign money wait for a corrective move to come in order to put in the big money to work? FPIs I'm talking about.
Yeah, so I think when I was talking about the flows, I was talking, Niraj, more about foreign direct investment, right? Yes. So what you're talking about is a little bit different. Yes. I would preface that what I talked earlier about our view of recessions in US and Europe starting now, China having a bumpy recovery at first. We differ to, I'd say, the consensus view in that we think India is going to be hit relatively hard by the global situation. So our view is we're probably a bit more negative than the consensus on global growth, but we do think Indian exports, Indian capex is very linked to what's happening in US, Europe, China. And so even with good balance sheets, we think India is going to face a notable growth slowdown next year. So FY24, our growth forecast is only 5.1%, which is significantly lower than the consensus or RBI's forecast. But FY25, we're at 6.8. So we're below consensus for FY24, above consensus for FY25. So getting back to your question on portfolio inflows, it is possible that there will be a lull for a while next year. And I would use the word patience, because I think it's hard. India will not be immune to the recessions we're about to see in the major economies. But once that happens, that could potentially be a very interesting opportunity to get involved in India, because, as I have mentioned, we think the medium-term outlook is very positive for India.
Great. Rob, before we wrap up this conversation, I'm presuming that you've looked at EMs in India. I mean, I know that you looked at EM in India for a long time. I presume that you've looked India slightly more closely in the last 12 to 24 months than what you may have looked before. And pardon my assumption if it's untrue. I would love to know what you think is different in India in the last 12 months than what you've seen in let's say the last decade. For a few people, the Jam Trinity and the whole digitalization stack is quite the strong suit. For a few people, it's something else. To your mind, what has stood out for you for India versus whatever else it was in the preceding decade?
That's a very good question, Niraj. I would say, firstly, the corporate sector is very healthy right now in terms of balance sheets. They've already been through, before the pandemic, a cleansing. And so if I think about the whole financing machine for corporates, they're in a much better place. That hasn't always been the case. And in India, with public debt quite high, you really do need the private sector to play a big role to get investment going. And that's what India really needs, right? That's how China did so well with double-digit growth for so long. It was through investment. And that's what you need as a developing country. And that's where we are very positive medium term for India. And linked to that, I would say, with a fairly stable government, we are starting to see reforms come through. You don't notice it from quarter to quarter, but you mentioned digitalization as an example, and I think there's been huge progress if I look back, say, 5 years ago and to where India is now. So it's these kind of things which I think you don't notice it from quarter to quarter, but cumulatively they've added up, and I think India could be at the cusp of a very strong rebound. And final thing I'd make on this is, in India, you look at India, you compare it to the past, right? And that's what you did to ask me the question. But another way to do it is compare India to other EMs, right? And if you look at Latin America, for instance, right now, the growth rate is very low. They're lacking investment, in hard or soft investment. You look at Central Eastern Europe, they've been really hit hard by the war. China is struggling with a lot of geopolitics. India, relative to the whole EM universe, has also improved significantly, not just because India's done a bit better, but because the others are struggling. And so from a global investor in EM, a discretionary fund, you're looking across the EM universe, the asset class, and I think that's where India stands out. So I do think from that perspective as well, India could attract significant inflows.
Great. Rob, well, for a lot of people who are listening in right now, or will listen to this or read about this during the course of the next few days, it's music to the ears, certainly music to the ears to mine. So thank you for spelling it out, and thank you for talking to us today. And from all of us out here, Rob, to you and family, season's greetings and a great holiday season.
Thanks very much, Niraj, and same to you and your family.
Thank you so much. And viewers, thanks for tuning into this conversation.